Hello and welcome to Commodity Champions, your weekly dose of what's brewing in the commodity space. I'm Manisha Gupta. And it has been a volatile week for crude oil prices. The output from US has been at record levels and the weekly inventories have seen a decline. This while we have seen a fall in OPEC output, and that has been the lowest in 13 months. The outages in Nigeria and Venezuela has not helped the cause at all. The premium for Brent crude has widened to $11 and experts predict the gap to grow further. Traders worldwide have been struggling to make sense of where the oil prices are headed, juggling countervailing signals from major producers Saudi Arabia and Russia on the path for future OPEC supply. To discuss this further, Edward Morse of Citigroup now joins us on the show. Ed, hi, good to have you. The crude oil prices clearly have been quite volatile, and we have seen the range forming between 75 to 80 on the higher side for the Brent prices. Would you now say that much that is being talked about in the global markets has been factored into the prices, or are we looking at more volatility?
Yeah, we're going to see a lot more volatility. The OPEC countries are trying to stabilize the market, but the more they try to stabilize it, actually the more volatile it will be. And I think there are, a bunch of reasons for this. There's probably a heightened amount of geopolitical risk in the market. I don't remember a market that has as much geopolitical risk as this one, not just from the standard producers, but from other factors as well. So we see the geopolitical risk factor coming in and coming out of the market. The producer announcement from St. Petersburg a week or so ago kind of calmed the market down, but we don't know whether they're going to do anything or not. We don't know how much Iranian oil is going to be off the market. We're in an era of the failure of the petrostate, and that takes oil out of the market unexpectedly. So, yeah, volatility is here to stay.
All right. But I understand the volatility will continue to stay until the OPEC meeting that is set to happen on 22nd of June. But the real question is, will OPEC come out with its own statement? Will it cut supplies? Will it increase supplies? What is your sense? Will OPEC and its allies actually increase those supplies and barrels into the market?
Well, I think they will. The question is when. And it's intriguing that the talk on adding oil to the market came from the Russian side, not the Saudi side. And the damping of that talk is coming from the Saudi side, not the Russian side. So, we have a series of statements from the Russian side that would indicate that Russian companies and the Russian economy may be better off at a lower oil price. So there is a real difference between these two giant market participants, Saudi Arabia and Russia. And it really has to do with their currencies. One currency, the ruble, floats, and it is tied directly to the price of oil. The other currency is tied to the dollar. It's pegged to the dollar. So it moves up and down with the dollar. The dollar's been appreciating. And higher prices mean higher revenue for Riyadh. On the other hand, higher prices bring a higher ruble. Lower prices bring a lower ruble. At a lower price and a lower ruble, you get more rubles per dollar on the petrodollar side, and therefore we have statements coming out of Russia that a price between 40 or 60 is a much better range for the Russian economy and Russian producers than is a $60 to $80 range. So there is that pressure, and sooner or later, I think we'll see that Russian pressure pushing the Saudis to put more oil in the market. And, of course, the Saudis are under other pressure as well. Mohammed Barkindo, the Secretary General of OPEC, has spoken publicly about pressure from the United States on Saudi Arabia to do something to bring prices down. The President of the United States is concerned, as is probably the heads of state in other countries, including your own, about the price of gasoline and the price of diesel in local markets as a result of what's happened to the dollar price of these commodities.
Oh, well, absolutely. And when you talk about India, that's exactly what my next question is really, Ed. What do you think about a nation that is India, where consumption growth is the fastest in the world, given the import dependence of India and the fuel prices being at an all-time high? Do you think India can sustain its consumption growth? And what should really be India's strategies from here on with the kind of volatility and high crude oil prices? So
the answer for that is yes, you're right. India is the fastest growing economy in the world in real terms, and it's the fastest growing country in the world in terms of the consumption of petroleum products. And the good news of that is that consumption is a direct reflection of GDP growth. It's a direct reflection of health in the economy. And sure, there is a drag, and there are things that can be done. And the things that should be done are to continue on the path of openness, probably encourage substitution, particularly on the LNG side. We believe the oil link in LNG is breaking and will be breaking on an accelerating basis, so that putting LNG in trucks looks like it's a very good idea, not just for environmental purposes, but for the flexibility of the truck fleet. China is a demonstration of that. They have an ability in the trucking fleet right now to switch some 300,000 barrels a day from diesel to natural gas or natural gas to diesel, depending on the competitiveness between those two fuels. LNG works very well in trucking, given the medium distances that have to be driven in a country like India, and it is certainly something that should be done. Fuel efficiency is another thing that could be done. California raised the minimum fuel efficiency for heavy-duty trucks driven with diesel. They doubled the fuel efficiency standard. The manufacturers of engines had no difficulty in moving from an average of 4 to 5 miles per gallon to 8 to 10 miles per gallon. Diesel demand in California at a time of growing GDP between 2009 and last year, it didn't grow. Consumption was abated. It stayed pretty even as a result of fuel efficiency standards. So I think there are things that government policy can emphasize that will not drag on the consumer side, not create the things that one worries about in terms of food and fuel inflation, but actually enable an economy to grow with more efficiency.
Well, yes. You know, the other thing that really seems to be bothering the markets is the kind of premium that the Brent crude commands right now versus the UTI or the Ural or the Dubai crude varieties for that sense. Do you see any sort of convergence coming anytime soon, or do you see this divergence really continue? And is it going to actually grow further?
So we're seeing a risk premium, and we're seeing all kinds of things happening with the spreads in crude oil. So one of the separate factors from whether there's a risk premium in Brent crude oil is the fact that the OPEC countries and Russia have taken heavier, sourer crudes off the market. And that means that, and the incremental supply in a relative value condition has been light, sweet crude. Scarcity has been on the heavy side, abundance on the light side, or relative abundance. So the spread between Dubai and Brent has narrowed to the point of almost vanishing, something that is done seasonally from time to time, but this is one of the consequences of the OPEC-Russian agreement. On the spread between WTI and Brent, that has to do with the U.S. system again, and the U.S. Is seeing phenomenal production growth. I think it's going to be between natural gas liquids and crude oil around 2 million barrels a day, year on year, 2018 over 2017. The problem is you can't get it out of where it's being produced. You can't get it out of the most prolific basin, the Permian Basin in West Texas. There isn't the pipeline takeaway capacity. We think this will ease this coming winter, not before then. In the meanwhile, we think that spread can blow out even further than the $10 we've seen in recent days. We think it could go to 18 to 20 and maybe even 25 if there's not enough capacity to take this oil out of the market.
Well, that would be something then, wouldn't it, Ed? But, before we let you go, what is your sense on where the crude prices are headed from here on? Because every report that you read is giving a different view. What, according to you, is a fair price? What is the risk premium? And how would you look at a quarter-on-quarter or an year-on-year forecast for crude prices?
Sure. And the only way you can think about this is through scenarios. In terms of your basic question, how much price is risk in the market? Now that Brent is coming back up again, it looks as though there was $5 taken out of the market that was pure risk. And there could be, in our judgment, another $5 on the risk side. Now, that risk is real. The risk is really tangible. There's a risk that companies, and one large Indian refiner just announced that they will not be taking more Iranian crude. The risk is really real that the amount of Iranian crude taken off the market will be not 100,000 or 200,000 barrels a day, but by this time, a year from now, it could be 800,000 to 1 million barrels a day. So the risk is there. It's a real risk. That crude is in the market today, but it might not be there come a year from now. There's also risk, not just from Iran, but from Libya, from Nigeria, from Venezuela, from the fragile countries in OPEC, and Iraq is also one of them. So the risk is palpable. Our base case is that that risk doesn't materialize this year to any significant extent, and that OPEC adds oil to the market at the end of the year, not the beginning of the year. So even in this scenario, we think the market will be flirting with $80 above and below through much of the year, and the ease will only come by the end of the year when all of this new production coming out of the U.S., Brazil, and Canada will come into the market, and we'll see inventories building again.
And that is where the crude oil prices perhaps may see a decline. Well, that is something that the Indian market, of course, could keep an eye on and would be a good news to cheer as well. But Ed, thank you so much, as always. Really appreciate you taking time out and coming and speaking to us on, of course, that very, very important subject. But with that, it's time for a short break. But stay tuned. We have Agriculture Secretary Shobhna Patnaik on the farmers' protest that is going on all over the nation.